You put in 50 hours this week. You earned that degree, you negotiated the raise, and you do exactly what you are supposed to do. Yet the cost of living keeps rising, and you are still stressing over next month's bills. You are running on a wheel, and the wheel is spinning faster every year. We sit in classrooms for over a decade learning geometry, biology, and history. During that entire sequence, no one teaches us how to read a financial statement or how to manage a mortgage. The system is highly efficient at producing compliant, hard-working employees, and it completely omits the mechanics of building personal capital. Without that education, society hands us a very specific instruction manual. Get a secure job, buy a house, save your excess cash, and avoid debt at all costs. If you follow those instructions perfectly, you encounter a mathematical certainty. The cash sitting in your savings account steadily loses its purchasing power. Because of inflation, saving money actually guarantees a slow, invisible erosion of your hard work. Adhering to the traditional playbook does not create a safety net. It creates a permanent reliance on your next paycheck, leaving you entirely vulnerable to economic shifts, corporate layoffs, and inflation. To understand how income actually works, we can map out the economy on this 4-part grid. Everyone earning money sits in one of these quadrants: employees and the self-employed on the left, business owners and investors on the right. If you generate your income on the left side, you are trading your time for a wage. Because there are only 24 hours in a day, your earning potential hits a hard mathematical ceiling. You cannot scale your physical presence. Jump over to the right side and the rules change. Business owners and investors build systems, deploy capital, and leverage other people's labor. The income generated here scales completely independent of the owner's personal schedule. People earning high salaries often try to build wealth by purchasing large homes or expensive cars. They categorize these items as assets. In reality, mortgages, maintenance, and depreciation pull cash out of their bank accounts every single month. Those are liabilities. The strict definition of a true asset is simple. It is a vehicle that puts money into your pocket, regardless of whether you are actively working. Financial independence is not achieved by securing a higher salary. It is achieved by acquiring entirely different categories of possessions, vehicles specifically engineered to generate passive cash flow. To acquire those assets, successful investors use a tool that the middle class actively avoids. They seek out debt. Toxic debt is consumer credit used to buy televisions, vacations, or cars, items that immediately drop in value while you pay double-digit interest rates. Strategic debt operates in reverse. Investors borrow capital specifically to purchase income-producing vehicles, like real estate. This diagram shows the exact mechanics of a real estate investment. The bank provides the initial capital to buy the property. A tenant moves in and pays rent. That monthly rent is split. One portion covers the bank's principal and interest, and the remainder drops straight into the owner's pocket as profit. Over a 30-year timeline, the steady devaluation of fiat currency means the fixed-rate loan actually becomes cheaper to pay back. Inflation eats the cost of the debt, while the physical property value and the rental income rise. Debt is a financial lever. When attached to an asset that produces cash flow, borrowed money allows an investor to multiply their holdings without triggering taxable income. Once you have cash-flowing assets, you have to protect that capital. The wealthy navigate this by utilizing corporate structures. A standard employee earns a paycheck. The government immediately extracts its tax portion, and the employee must try to survive, and perhaps save, on whatever is left over. This chart shows how a corporate entity reverses the sequence. A business earns revenue, spends that revenue on operational expenses and expansion entirely pre-tax, and is then taxed only on the tiny sliver of profit remaining at the bottom. These structures aren't illegal loopholes. They are the written rules of the tax code, designed to encourage business growth, and they allow capital to compound much faster than a standard W-2 wage ever could. Understanding these mechanics is useless if you are paralyzed by the fear of making a mistake. The traditional school system conditions us to view failure as a permanent mark against our record. In the real world of investing, playing not to lose guarantees you never win. Mistakes are not punishments. They are the required data gathering process. You test, you fail, you adjust, and you try again. You build resilience through action. By forcing a portion of your income into an asset column before you pay your bills, you create a necessary pressure. That pressure forces financial innovation and discipline. Ultimately, you have to discard the idea that wealth equals a large salary. Wealth is a measurement of time. Ask yourself, if you stopped working today, exactly how many days could you survive on the cash flow your assets produce? Your mind is your greatest asset. By investing the time to understand how capital actually flows, you make the permanent transition from working for money to making money work for you.